Welcome back to Alpha Recap. I'm glad you're with us. Markets were closed for the day, and we're walking through the biggest takeaways from the session. As always, if you have questions, you can reach us at stockalpha.ai. Today we'll cover AI momentum and volatility, a sharp sell-off in offshore services, a medtech downgrade, some corporate housekeeping, and a few ESG and consumer updates that caught our eye. Josh, ready to dig in?
Always. Lots to unpack from a fairly active tape, even though the moves weren't always headline-driven.
Let's start with the tech biggie. Nvidia finished the day down just under 1%, about 1%, landing around $188.54 on heavy volume, roughly 136 million shares. That's notable even without a company-specific announcement. What did you make of that action?
It was interesting. A sub 1% drop on outsized volume is the sort of thing that tells you positioning shifted. Large volume with a small price move usually means either profit taking from big winners or options-related flows getting unwound. In plain English, investors who had big gains may have decided to lock some profit, and market makers could have been rebalancing. The key is that Nvidia remains a volatility amplifier for the whole AI and semiconductor complex.
So even a modest decline in Nvidia can ripple through AI suppliers and software names.
Exactly. When a leader like Nvidia ticks, sentiment towards suppliers, software partners, and index allocations often follows. That's why we flagged it. The price move itself wasn't dramatic, but the volume made it meaningful.
Speaking of suppliers, Apache announced new SSD power management solutions aimed at edge and mission-critical systems. Explain why that mattered alongside the Nvidia move.
This is a structural point. As AI workloads move from big data centers to edge locations, think factories, telecom towers, or even retail sites, energy efficiency and reliability become procurement dealmakers. If a supplier can prove a lower total cost of ownership, better power stability, or longer life cycles, enterprises will prefer them. In short, it's not just raw chip performance anymore, it's how the whole stack behaves under real-world power and reliability constraints.
So Nvidia's demand outlook and Apache's engineering focus are two sides of the same infrastructure cycle?
Yes, if buyers start prioritizing energy-efficient, resilient storage and compute, vendors that can show those advantages may win design-ins, which can be a second-order revenue driver beyond just selling chips.
Let's pivot to the energy space. Transocean plunged, one of the bigger single stock moves today, down about 4.33% to $5.46 on heavy trading, roughly 117 million shares. That was the session's larger drawdown. How should investors interpret that?
That action highlighted ongoing fragility in offshore services. Companies in that space are cyclical and capital intensive, meaning they need lots of cash for rigs and maintenance, and they're sensitive to oil demand cycles. A sell-off like that can reflect position adjustments, negative news, or simply broader risk-off behavior in energy service exposure. The practical takeaway: if you're overweight offshore services, you should be watching whether weakness broadens to peers or stays isolated.
Okay. On the healthcare side, JP Morgan downgraded Atracure to neutral, pointing to competitive pressure from Edwards Life Sciences. That seems like a classic market share story.
It is. Downgrades like this are analyst reactions to the idea that well-capitalized incumbents can squeeze smaller players. For medtech, that usually means longer sales cycles and the need for more R&D or commercial spending to defend share. For holders, it raised the risk of margin compression and higher near-term volatility. For prospective buyers, it suggested waiting for clearer signs of product differentiation or a renewed share growth signal before increasing exposure.
You mentioned margin compression. Explain that in plain terms for listeners who might not be deep in sector details.
Sure, margin compression means a company makes less profit on each dollar of sales. If a competitor starts taking customers, the smaller company might have to spend more on sales teams or lower prices to keep business. Those extra costs or lower prices directly reduce profit margins, which can hurt earnings per share and, by extension, the stock price.
Got it. Let's move to legal and corporate housekeeping. Rich Tech Robotics had a shareholder action notice with an April 3rd deadline for purchases in a specific window. La Rosa sold a majority stake in a real estate subsidiary for $500,000 and implemented a licensing agreement to keep access to its tech. And PLT Health Solutions plans product and clinical updates at Expo West. How do these kinds of items affect investors?
These are classic idiosyncratic catalysts, meaning they affect one company at a time rather than the broader market. The Rich Tech deadline is important for anyone who traded in that window. It's a potential legal claim that can change who holds the stock and liquidity in the short run. La Rosa's sale is a balance sheet cleanup that could improve margins if they redeploy proceeds or remove an operating drag. PLT's trade show presence is a visibility event that can lead to retail or distributor deals, and those follow-up win announcements are what turn a product debut into revenue. Active traders and event-driven investors watch filings and follow-up communications closely.
Quick reaction. If I owned Rich Tech and traded in that window, I should be looking at counsel or the notice before April 3rd?
Yes, the deadline matters. If you bought in the specified dates, you may have a claim. Consulting the notice or seeking legal advice is the sensible next step.
Switching gears, there was also an ESG-style partnership involving the IUCN and Huawei with the Maldivian government on marine protection. No financials were disclosed, but it sounds like a reputational positive. How should funds and suppliers think about these announcements?
These projects often signal that governments and NGOs are partnering with tech vendors for environmental monitoring. For ESG-focused funds or companies that supply tourism or conservation tech, it's positive reputationally, but investors should be cautious about assuming near-term revenue. Until contracts, budgets, or timelines are disclosed, these are optionality plays, potentially valuable over the long term, but not a near-term earnings driver.
There was also a consumer accessories note. Taurus launched a fashion-forward phone case line. No financials there either, but a reminder that accessory makers chase higher average selling prices through branding.
Right. For accessory makers, the real revenue catalyst is distribution, retail partnerships, or direct-to-consumer scale. A product launch gets attention, but watch for subsequent deals and shelf placements.
Let's run through some rapid hits so listeners have the numbers in their heads. Nvidia down about 0.75% to $188.54 on roughly 136 million shares. Transocean down about 4.33% to $5.46 on about 117 million shares. AtriCure got downgraded to neutral. Rich Tech had the class action window with an April 3rd deadline. Apache announced SSD power solutions for edge and mission-critical use. PLT was showcasing at Expo West. Maldives partnership announced. La Rosa sold a majority stake for $500,000. Anything to add on those quick hits?
Just that those quick items underscore two themes we kept seeing. One, AI and infrastructure converge on energy and reliability decisions. And two, small and mid-cap names remain exposed to idiosyncratic moves tied to legal, corporate actions, and visibility events. Treat each small-cap move as its own story, not necessarily a macro read.
Good transition. What were the emerging patterns or trends you pulled from the briefs?
4 patterns stood out. First, AI and infrastructure decisions were increasingly driven by energy efficiency and reliability, the Nvidia and Apacer connection. Second, analysts were quick to spotlight competitive risk. The AtriCure downgrade is an example. Third, small and mid-cap idiosyncratic risk stayed elevated. Legal notices, asset sales, product launches can move single names sharply. Fourth, ESG and public-private partnerships kept appearing, but they often lack immediate financial clarity and are more about optionality than predictable revenue.
Let's make this practical. What should investors have been watching into the next session, and why?
A few things. Watch Nvidia's follow-through volume and options flow. Continued heavy turnover or another leg down would amplify moves across AI and semiconductor suppliers. For Transocean, check support levels and whether peers display similar weakness. If selling spreads, energy service allocations may need rebalancing. For AtriCure, look for management commentary or follow-up analyst notes. Any rebuttal or data on market share could swing sentiment. For Apacer, the big watch was customer design wins or efficiency metrics. That turns a product release into a revenue story. For La Rosa, see how they use the $500,000. Reinvestment versus cleanup matters. For PLT, watch post-Expo West distribution announcements. And for Rich Tech, monitor filings and any company statements before that April 3rd deadline.
Nice checklist. From a portfolio posture standpoint, how would you have recommended investors position after the close?
For growth investors, Nvidia's dip was a watch event, not a structural sell signal. Position sizing discipline made sense given the volume-driven volatility. For sector and long-only investors, keep an eye on cyclical signs coming from Transocean and peers because those read through to oil services demand. For event-driven and active traders, legal deadlines, asset sales, and trade show announcements created short-duration trading windows where prompt attention to filings and follow-ups could pay off.
Before we wrap, give our listeners 3 clear takeaways from today's session.
1. AI and infrastructure conversations are shifting from raw performance to energy efficiency and resilience. That's a theme connecting Nvidia and Apacer. 2. Analyst downgrades and legal actions remind investors that idiosyncratic downside risks remain real for mid and small cap names. 3. ESG partnerships keep showing up and are reputationally positive, but they usually lack near-term revenue clarity, so treat them as long-horizon optionality unless contracts and budgets are disclosed.
Perfect. Quick housekeeping. If you bought rich tech in that eligible window, consult the notice and consider next steps before April 3rd. If you hold Atricure, wait for management reaction or more analyst work before making big changes. And review your exposure to Nvidia if you're sensitive to volatility.
And remember, many of these moves were driven by volume and headline liquidity rather than fundamental shocks. That doesn't make them less important, but it does mean active monitoring usually pays off more than knee-jerk moves.
All right, that's a wrap for today. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll be back after the next close to recap what moved markets. See you then.